Welcome, everyone. So I want to kick it off today's webinar with a question. And maybe you've experienced this yourself. You see, a lot of accredited investors I talk to think that the only way they can get to $1 million added to their portfolio, to stack it on top of their net worth, is to take big swings in equity-like investments. But what if I told you that your next $1 million added to your net worth could actually come from short-term compounding investments that are highly liquid and offer stabilized monthly cash flow? All right, we are going to answer this question today in today's webinar, but before we do so, I want to get my computer working. All right, so today's topic, we're going to tackle how to add $1 million to your net worth with debt funds. Now, if this is your first time joining our Passive Investing Made Simple Masterclass, you're in the right place if you want to learn how to take your active income and savings and turn it into long-term income and wealth. Now, maybe you've tried investing in passive real estate before and just couldn't quite get comfortable with the investment, or you actually invested in a deal before and realized, whoops, it's not the right fit for me, or you are a seasoned pro and you simply want to sharpen your skills so you can take advantage of the current market cycle. If that's you, you're in the right place. Now, if you're watching the video, normally there's a picture of me and my crazy crew, my husband and my daughter. We love traveling, camping, doing all sorts of things, fun things outdoors. But we're having a bit of an issue with Amazon Web Service. So that picture is not there, but imagine this. My husband, myself, our daughter in front of some beautiful mountains in Glacier National Park. What has allowed me to do that is scaling the portfolio that I have. I've scaled over 800 million in active real estate holdings. That doesn't count my passive investments. Done the fix and flipping. I get to share my journey with you as the Director of Investor Education here at passiveinvesting.com. And I've actually documented this journey in my book, Money for Tomorrow: How to Build and Protect Generational Wealth. Now, if you want to check out that journey, learn more about, how I scaled my first couple million, you can do that by checking out that book on Amazon or Bigger Pockets. Now, all of this is in service of one result. What I was very cognizant about, very deliberate about, is how could I craft a portfolio that would allow me to get 100% control and choice on how I spent my time. I'm not in it to build the largest portfolio. I'm not in it to have the most number of units. I'm in this investing game in order to achieve one thing. How can I buy back my time so I can do what I want, when I want, with whom I want? And I imagine that message also resonates with you, and we can help you do that here at passiveinvesting.com. So be sure to join our Passive Investing Club. You can jump on a one-on-one call with me. We can discuss your passive investing goals and also talk about which investments we have that might help you achieve those goals, as well as connect you with additional resources to help propel you along your journey. Now, make sure to visit passiveinvestingwithwhitney.com in order to get connected to all these resources. Now, today's topic, we're talking about how to add $1 million to your net worth through debt fund investments, not swinging for the fences on equity investments, not, sweating out market timing and all that. Now, we are going to talk some numbers today, so this is not financial advice, tax advice, or legal advice. Make sure to take all this information back to your team before making any sort of investment decisions. Now, the reason why I wanted to have this conversation right here, right now, is for two reasons. Now, we talk quite a bit about adding cash flow into your portfolio to complement the growth assets that you have in your portfolio. But here's the thing. Market reality is still hitting us. Okay, rates are coming down. We're recording this in October 2025, and we're expecting more drops to come. But that does not mean the pressure is off the equities markets at all. Okay, we're still seeing struggle here. Now, I'm not saying don't do an equity deal. I'm just saying if you want a different option, to securely add $1 million to your portfolio, I'm going to show you how to do that today. Now, here's the alternative. A lot of investors are either, I'm going to do an equity deal or a bust. So they're sitting in cash on the sidelines. I'm going to show you how that is actually eroding your wealth. You see, investors actually need an alternative path in order to continue seeing momentum growth within their portfolio. Okay. So that's where the predictable power of cash flow from debt fund investments can really help you continue to take incremental steps, or if you like baseball analogies, you keep taking base hits to keep your money moving while you wait for market changes. But you can do so without taking huge, stressful, decisions into an equity deal. Will it, actually work out in today's market? You can eliminate the high risk and you can eliminate the capital lockup right now. Okay, now usually this is when I get pushback from an investor. Well, Whitney, I'm going to sit on the sideline right now, all in cash. Then I have another one that is like, you know what? I'm gonna, sit in the sideline for a little bit and then I'm going to wait for the equity deal. Now, I'm going to show you the math on that, how that actually can hurt your portfolio. But let's just say if you did nothing at all, had $100,000 invested, and was waiting for your specific tier of investment choice to appear right now, today, in today's market, this could mean a $274,000 gap in your portfolio. What do I mean? Okay, so if you had $100,000 and it added $50,000 a year to it, that investment, and just kept it in your savings account. This is pending on that savings account continue to return 3.5%. Okay. You would have $739,000 at the end of 10 years. Okay. That's if we allowed it to compound. Now, stocks, bonds, and mutual fund, if we took the average return of investing, say, $100,000 in the stocks, bonds, and mutual fund 60/40 portfolio, pretty not terribly conservative portfolio, but a standard portfolio. And then we continue to add 50K to that investment for the next 10 years, we'd have $961,000 in that portfolio. Whereas if we went into a debt fund-like investment that yielded at 8%, so we started off with $100,000 in that debt fund investment, it automatically is earning 8%, and then we continue to add 50K every single year and continue to grow that portfolio, you would, at the end of 10 years, you would end up with $1.1 million. So this is a $274,000 opportunity cost if you're sitting here waiting to, actually larger if you're waiting in cash, and if you decided to go into the market into a conservative portfolio. Now, we can do that all with less stress too, whether the stocks, bonds went up, down, or sideways. So there's really a wake-up call here. And I'll pull a recent investor conversation that I had. One investor that I was speaking to, she was just like, hey, I'm going to continue to wait for an equity deal. And she did so for 18 months. And on that money that she had set aside, she made zero return. Okay. And I say zero because, she added in a savings account, maybe made 3% on that high yield savings account. But if we take into account inflation, that 3% is essentially wiped out. And she missed out just that 18 months, that one little time period sitting on the sidelines, $60,000 of compounding growth. All right. So this is what I want to show you how to avoid today in your portfolio. Okay. Now, I'm going to have some other naysayers. Maybe that's you. Why should I risk investing in a debt fund investment that produces cash flow if I could safely get 3.5% in the bank? Well, again, that barely beats inflation, and that rate is going to continue to drop as the Fed fund rates drops. Okay. So this isn't about safety. It's about safety and growth. Number two, I I have the investor that doesn't want to go into any investment right now because they don't want to lock up any funds in case they find that amazing equity deal next. Here's the thing, with the properly structured debt fund, you will also maintain liquidity. So you could be earning while you wait. Okay. And then we've got investor number 3 that just says, okay, Whitney, I'm going to push back on you a little bit. How do I avoid the junk debt funds? Because just because I say debt funds, that you should look at debt funds, that does not mean all debt funds are alike. Okay. We can have very conservative debt funds. We can have debt funds that are riskier than an equity deal. All right. So I'm going to show you how to use the 3P framework, people, process, and positions to evaluate the structure because not all debt funds are created equal. All right. So let's talk about peace of mind here. When we are looking at evaluating a particular debt fund to go in our portfolio, we want to make sure we're answering 2 questions. One, what is going to provide us peace of mind? Okay. And for most people, the reason to add the debt fund investments to the portfolio is to actually stabilize it with cash flow, consistent cash flow, not cash flow that comes in 2 years or 3 years. I'm talking about monthly cash flow, maybe quarterly cash flow. Now, you don't have to use it. We can continue to compound it. I'll show you how those numbers work. All right. But the consistent cash flow of a properly structured debt fund can help tap into this peace of mind. Also, having cash come in on a regular basis and maintaining liquidity of those funds, access to those funds can give you, what I call a high sleep well at night factor. All right. For me, I love that. I love a good, healthy, um, sound night's sleep. I don't want to be stressing about, do I have access to the funds when I need to have access to them? Do I have my portfolio kicking off the cash flow that it must kick off in order for me to meet my needs? I intentionally structure my portfolio to answer these 2 questions and provide that peace of mind. All right. The debt funds also, when you add this type of instrument into your portfolio, can actually stabilize that heavy equity portfolio. So maybe you're like me, who is a very heavy into multifamily value add real estate. Now, that is fantastic. I still have my portfolio. I'm holding on, through this turbulent time and navigating that portfolio, and hopefully we see rosy, good exits on the other side. But the debt funds actually stabilize my portfolio in order to provide that cash flow growth. So I don't have to liquidate an equity asset in a down market. The other cool thing and this is, for me, is I like having my money outside of the bank and working, but I want it in my control, meaning I can liquidate it when I need to and when a riper opportunity appears. So again, this is not about, replacing equity deals in your portfolio. This is how do we continue to drive momentum forward and build that healthy foundation in order to continue to grow your portfolio. So I'm going to offer you a 6-step framework, okay, on how you could identify how much of your portfolio should shift into a debt fund or a cash flow tier in your portfolio. And then how do we kind of set the target for what we're going to invest in? And then how do we underwrite it? How do we evaluate the risk? Okay, so step number 1, we're going to talk about the timeline. Step number 2, we're going to talk about that passive income target. Step number 3, we're going to talk about what are we going to allocate in order to keep your portfolio overarching stable. Then we're going to talk about steps 4, 5, and we're going to talk about evaluating risk and how to underwrite to that risk. And then 6, we're going to talk about consistency. How do we stay consistent and allow this debt fund investment in order to help us continue to build and scale our net worth? All right. So step number 1, if you've been with me for any length of time, you know that I always start at the beginning, okay? We have to define our goals and our timeline. So think about this. When you are going to introduce or maybe even grow this part of your portfolio, where are you in your investing timeline? Are you in your accumulation phase, meaning you've got 20, 25, 30 years to continue to pivot and maybe stay in growth heavy assets, right? It's not a matter if an asset's going to be challenged, it's a matter of if and when, and will it cause a sequence of risk issue in your portfolio. So if you're in the accumulation phase, totally get it. Maybe minimal exposure to debt fund assets, but worthwhile to continue to consider to add those. If you're in the transition phase, maybe you're within 10 to 15 years of when you actually want to fully retire, we need to start preparing to add in these income streams into our portfolio. So it doesn't mean we have to liquidate necessarily equity assets. That is one option. It just means as equity assets exit, can we take some of that money and pivot it into that debt fund or cash flow tier? Or are you in the cash flow phase of your portfolio timeline, meaning you actually need to prep within the next 5 years or now to have stabilized regular income coming in from your assets? Meaning you technically are done growing them. Not to say that we can't continue to grow them, but we're not going to invest for growth necessarily. We're going to invest for cash flow. And if we can get compounded growth off of it, awesome. Okay, so your timeline is going to dictate your needs and how we're going to allocate that portfolio. Now, step number 2, we got to actually set our passive income target. If we are going to insert a cash flowing tier into our portfolio, if we're going to satisfy that with debt fund like investments, before we can allocate the capital, we need to know what kind of income we needed to kick off. Now, I really encourage people, we'll work through the numbers. I'll help you orient to the what you see on the screen. But remember, with cash flow tiers, with debt funds, we're not trying to hit 14% IRR or higher. We're staying in that narrow band between, say, 6 to 10% annualized coupon. The higher we go in the rate, probably the more risk we're taking on, and sometimes it might be unnecessary. So we're hitting that return sweet spot is going to be between 6 to 10%. Now, our cash flow needs are going to differ based on where we are in our investment timeline, but also what milestone we're trying to hit in our investment journey. Are you just, starting off getting cash flow stabilized in your portfolio? If so, let's get you financially secure, meaning you got enough cash flow coming in on an annualized basis to cover the essential bills and basic living expenses. Roof over your head, food on the table, all your utilities paid for, okay? And maybe if you're still working, commuting to and from work. Then the next milestone would be financial vitality. Okay, how could you comfortably fund a desired lifestyle? Now, this isn't the one that you actually live currently right now, but one that's not too shabby. You're going out to eat, you're doing all sorts of, like a little bit of fun things, maybe not traveling extensively or extravagantly, but, life is good, right? If all the cash flow stopped in your portfolio, life is still pretty good. Then we got financial independence that covers all of our expenses today. And then, of course, the last milestone, which if you're here, I know you're achieving or striving to achieve, which is that financial freedom milestone. How do you live entirely on your own terms without financial constraint? So it's super important. Step 1, where are you in your timeline? Step number 2, which financial milestone are we trying to hit? We have to determine these before we can start safely allocating capital. All right, step number 3, prioritize stability. Okay, if you go to our passive investing DOT.com YouTube page, okay, so that's the handle, passive investing DOT.com. Essentially you'll see multiple videos on how to build a 3-tier fortress balance sheet. Okay, this is a culmination of a lot of my research of some of the most powerful, famous investors out there. They all have their emergency reserves set aside, their liquidity tier set aside, their investing war chest, right? They have cash flow coming in their portfolio. And then once they have those other tiers met, then they go invest for growth. And then they toggle back and forth. Like as their growth assets exit, they'll allocate more to their cash flow tier. As they don't need the cash flow, they can compound that in order to grow. So they're continuing to tip between that cash flow growth tier. So, but how do they do this? I think the biggest question that you as an investor are probably asking yourself, and maybe you'll, one that you have emailed me in the past, is that stability tier is probably 30 to 40% cash and cash flow like investments. Now I'm going to pause. I'm going to let that sink in. Go take a look at your portfolio, all of your investments. Okay. How heavily invested are you in that stabilized liquidity cash flow tiers, those bottom two tiers? Okay. That's what's crucial for helping you create this type of portfolio. And then we can layer on the growth assets on top of it. Then we can continually balance back and forth between growth and cash flow to continue to stabilize and grow the portfolio. And this allows us to stay nimble for those emerging opportunities that we want to see. All right, so we got our timeline. We know which financial milestone you're going for. We know, if you need to start taking some, reallocating to those cash flow tiers to stabilize your portfolio. Now you're to the point of starting to allocate into debt fund investments. Okay, but what does that really mean? Okay, so debt funds means we go into an pooled investments. In this case, in our PIC real estate debt fund, we are writing loans, okay, originating loans to fix and flippers, okay, for their residential real estate needs. Okay, they exit in 6 to 9 months. All right, that money comes back to the fund, then we deploy it again. We're continuing to generate fees and interest into the fund, and then we share it with our investors. Okay, but here's the thing: just because I said debt fund, in this particular debt fund, is first lien position, but most investors I talk to, they don't know how to underwrite a debt fund, and they find themselves judging debt fund based on the return, not the risk. So let's actually pick apart what makes a debt fund risky or not. And I tend to distill it down to these 4 key areas. One, what capital position are you in? Okay. Are you actually the bank on the deal, meaning first lien position? Are you the line of credit on the deal? Okay, meaning you might be in a mezzanine type position. Or are you actually pushed up into an equity tier that somebody convinced you that you're actually holding debt, which is preferred equity? Okay, so you have to understand, where are you in what we call the capital stack? Are you in the most secure position, first position lien? Are you in some sort of second lien position, maybe even a promissory note position? Okay, nothing wrong with either position. You just need to know, so you can evaluate your risk. Or has somebody convinced you that you are in a debt position when really you're in an equity position? All right, then what kind of asset type is it? Okay, is it residential, commercial, industrial, land? I put these on a continuum because everybody needs a roof over their head. Okay, not everybody needs an office or a self-storage unit or a car wash, right? Not everybody needs an industrial facility. Okay, land, there are risks that come with land. Getting all the utilities to the land, the permits to build on the land. So just know each one of these asset classes provides a different risk profile and has different supply demand metrics within the market. All right. The third place to really evaluate when it comes to a debt fund is what phase of the asset development is the debt fund investing in? Meaning, is it investing in an asset that's completely stabilized? Okay. More than likely not, right? More than likely, there's some sort of value add component to it or distress component to that asset because the borrower is borrowing money, okay, for an asset that's below value so they can actually reposition it and push the value higher and they make the spread. All right. So development phase, most debt funds I see are not stabilized assets. There's some sort of like value add or distressed asset. Okay. And there's all flavors in there, right? It can be complete. It could just be like a minor rehab that needs to happen on the property. We call it lipstick on a pig, maybe with fix and flip residential real estate. Or it could be you're tearing something down to the studs and rewiring, replumbing. Okay. Or is it investing in a project that's doing ground up development? Again, knowing the development phase is also going to help inform the risk of that debt fund. All right, and then we get into the legal structure. All right, that's kind of the last piece. Are you investing in a direct note to the investment? Meaning, am I, Whitney, lending you $100,000 so you can buy a investment property, fix it up, and then pay me off? Or am I, Whitney, investing in your fund and your fund has hundreds of notes like that in it? Okay, where I'm getting instant diversification over borrowers, markets, and deals. Or am I, Whitney, investing in some crowdfunding platform um, that may or may not be doing adequate underwriting on the deals that are being listed on their platform? Okay, so again, understanding the structure of the fund too is going to inform the risk as well. All right. Now, once we understand the risk and we've aligned it and we have identified a fund that we're like, hey, this actually is pretty good. It's aligned with the risk that I want to put in my portfolio. Now we need to learn how to actually underwrite that deal. Now, for the sake of today's webinar, we have other webinars that go into debt fund underwriting in deep detail. You can find those at our YouTube page, Passive Investing DOT.com. Okay, but I want to make sure that you understand 3 key areas to underwrite. And that is you want to know the people running the asset, the processes, how they're running the fund, and then the protections they're putting in place. And when we come to the people running the fund, we actually, in a debt fund, we have 2 people that we need to underwrite, the fund manager and then the lender, whoever's lending the money. We want to know on both ends the track record of the operator, their lending experience, and are your interests aligned together? And then we've got the processes. Okay, we want to go through all of the lender's processes. How are they screening the borrowers? How are they evaluating the assets? How are they monitoring that the borrowers are doing what they're supposed to be doing? And then, should a borrower get in trouble, how are they handling potential defaults? Because again, it's not a matter of if will it happen, it's a matter of when it will happen. So you want to make sure you're working with a lending team that has very strong systems. And then we get into protections. Based on the borrower or the lender's processes, what protections do they have in place for you as the lender? Okay, because you're lending money to the fund. Are you in first lien position? Is there conservative loan to value on the asset? Meaning, do they only loan 60 to 65% on the value of the asset? Does the borrower give some sort of guarantee on the asset? And then what are their backup plans in place should a borrower actually hand over the keys? Meaning the asset had to be foreclosed on. Okay. Does the lender have a way of repositioning and dispositioning that asset? Okay. Then we get to step 5. All right. So 1, our timeline. 2, we're talking about, you know, what type of financial measure are we trying to hit in our portfolio? Then we get into understanding our different risk in this. We're evaluating the actual deal. Now, you've gotten into a debt fund deal. Now, what do? Well, in order to add $1 million in net worth to, or $1 million to your net worth through debt fund investments, it's pretty simple. You just reinvest your proceeds. So continue to reinvest your distributions. If you can do so automatically, do that. Okay. This makes it easy. Okay. I know I sometimes will collect my distributions and reinvest every quarter. Okay. Maybe shaves a tenth off of my total return. For me, it gives me the warm and fuzzies. I like doing it that way. Okay. That'll help maximize growth. Number two, establish a way to continually, regularly contribute to that tier. So that can come through automated transfers from your business, or if you're a high income worker, or just if you are scheduled reminders on your calendar to liquidate some of your equity holdings and move the money over, and then continue to monitor your investment and allow it to compound. Right? Compounding isn't math. I mean, it is, but at the end of the day, what we're doing is we're trying to tap into a behavior that allows us to grow money, grow our wealth. So we have a tool that we can do what we want, when we want, with who we want. All right. So key takeaways from today before we open up the floor for question and answer. To grow big wealth in your portfolio, it can be taking on small wins. It does not always have to be these big, swings for equity. Okay. You don't need home runs to hit millionaire status or add $1 million to your net worth. It's just about consistent and persistent behaviors and allowing all of that to compound for you. Key takeaway number two, stop waiting. If you're sitting on cash, get it working for you. Let's get it into earning more than what you could in the bank, earning more than what you can in order to beat inflation, because we don't know, if inflation is going to stabilize, go down, or go higher. We're still in this volatile market. And then let's make sure that you are building that stabilized portfolio to help you accelerate that growth to $1 million. Now, before I open up the floor for Q&A here, if you're ready to map out your next move, how something like this could fit into your portfolio, make sure to join the Passive Investing Club. You can join it there at passiveinvestingwithwhitney.com. Again, you get a one-on-one call with me, access to our open deals, and additional educational information to help you on your investing journey. If you're here live, don't go anywhere. We're about to start the Ask Me Anything part of our show. Awesome. All right. As always, I want you to go to the chat, to the Q&A box. Tell me what you love. What is something you're going to take away and implement from today's talk? What would you have loved to see, or a question that you have? And let's get those questions answered. Can we invest with our retirement accounts into a debt fund? Yes, at least into our, what we call our PIC real estate debt fund. Yes, you can use your retirement account investing. That's actually an incredibly powerful way to minimize any tax impact on your portfolio. And taxes are so personal for people, so I generally kind of stay away from it unless like somebody's specifically asking a question. But yes, retirement accounts. One of my favorite ways to do this is to invest in debt funds through my Roth retirement account, because I already paid the tax for the money to go into the Roth, and then I can invest in the Roth, and it grows tax-free, comes out tax-free. So, but even then, in your traditional IRA account, you can do it there too. No problem at all. Solo 401ks, SEPs, simples. Yes. And this matches all those different retirement accounts. And that can be a very powerful way to grow your wealth for sure.